JP Morgan, Wells Fargo, and Citi all reporting better than expected results last week. And big bank earnings will continue tomorrow. A little bit different, though. Morgan Stanley, which is sort of a darling all of a sudden, plus B of A, which has been dead money for quite a while. We're going to get some key regionals this week as well to talk about what we've seen so far and what else to expect. We're joined by Barclays Managing Director and Senior Equity Analyst Jason Goldberg. And I asked you off camera, I go, you got to make this interesting. And suddenly I got really interested in the whole subject by thinking about some of the issues. So it is kind of an interesting time to be a bank analyst, is it not?
There's always something going on in the world of financial services.
So the yield curve is, I mean, it is possible to make some net interest income. That helped the banks. My question to you was, when the Fed goes up 550, whatever it is, 500 basis points, duration risk seems like it could be a big problem. And we saw it in a couple of places where it was a major problem. How come the rest of these guys were able to manage it, as you said?
Yeah, no, I think what you've seen earlier this year in, Silicon Valley and First Republic and Signature was, really poor risk management. I think certain banks, always position themselves for various interest rate environments, and that select group of banks just completely mismanaged the situation. I think by and large, the vast majority of banks in this country have much sounder policies, and while you may see some net interest income pressure going forward, nowhere near the same degree what you saw at those institutions.
One other thing that we brought up last week was a long-term Citigroup chart, because it was up 40-something. That masks what really happened at Citigroup. I don't know if we have the chart from last week that we ran, but there was a 1-for-10 reverse split. That's still a $4.80 stock. So there were two guys. One guy was named Chuck. One guy was named Jamie before Andrew wrote his book. What was the difference between Chuck and Jamie?
Yeah, I think it goes back to your initial question. It's risk management. And what you saw, prior to the financial crisis, is Citigroup take on a lot of undue risk, whether it's subprime ABS CDOs or subprime mortgages, and completely mismanage the balance sheet. Similar to what you saw with Silicon Valley and First Republic, again, balance sheet mismanagement can certainly wreck a financial institution. In the case of JP Morgan and several other institutions, didn't take on concentration risk, managed the balance sheet appropriately, and, kind of sailed right through that financial crisis. And what you're seeing this year is, those with better risk management, stronger management teams are certainly outperforming those that don't have the same wherewithal.
Well, who's sitting on just a lot of commercial real estate that could be a major problem?
Yeah, so, we focus on the top 20 banks, which, by and large, are not overly concentrated in commercial real estate. Among the top 20, 4% is kind of the maximum amount of commercial real estate loan banks have on their balance sheet, and it's a select few. Where we worry is, as you kind of go down the spectrum, there's a lot of regional banks with kind of outsized office exposure, where you certainly are starting to see cracks. You saw non-performing assets and net charge-offs that some of the bigger banks reported Friday, increased with respect to the commercial real estate sector, and it's certainly something to keep an eye on down the road. But nowhere near the same degree of kind of systemic risk that we saw earlier this year.
So we're in pretty good shape overall.
Yeah, certainly we think loan losses will go up, but very manageable in the context of the bank's earnings capacity.
How about Morgan Stanley? They're going to continue to, I don't know, they haven't really left the pack behind, but Gorman's done a pretty phenomenal job. Right?
Very well. In the near term, though, there are certainly some challenges. What you saw on Friday at both Citigroup and JP Morgan is trading revenues were down year over year, investment banking fees were down year over year, albeit off of strong levels, particularly with trading. But, there's certainly some near-term capital markets pressures, although, we did see some improvement in June, so we're hopeful that carries through the rest of the year.
How about Bank of America?
Bank of America, I think you'll see this quarter, right? You saw the biggest banks report on Friday with, decent net interest income results relative to expectations. We do think the bigger banks will outperform there. I think where our concern lies is later in the week when we get some of these regionals, we do expect net interest income to be under pressure as just the cost of deposits continues to rise rapidly.
Is it wrong for me to think Bank of America is somewhere in between Citigroup and JP Morgan in terms of how they've done since the financial crisis?
I think that's a fair assessment. I think, it's interesting. Bank of America and Citi were both, did not handle the financial crisis relatively well. And what you've seen since is, Bank of America, took, I think, aggressive actions to clean up the franchise. Citi was a little later to the party. So you had a CEO change a year or two ago, and they're just now kind of remaking their franchise, where Brian Moynihan started that journey back in like 2010.
So your 3 buys, you got regional buys or money center buys?
No, our buy recommendations are certainly slanted towards the biggest banks.
Which ones?
JP Morgan.
You like that?
We do like JP Morgan. We thought Wells Fargo had a good quarter Friday. They should do well as well.